There we go.
Oh, okay. Hey, perfect. I only got about 10 minutes before anybody let me know. So,
Well, actually, I just brought up Steve Kayaza here, who kind of helps me out with these webinars as well, Greg. And
okay.
so thank you very much.
Yeah, I appreciate it. You know, that's occupational hazard being an attorney. I just get in my own little space and keep talking and ignore all of the rest of the things going on around me. So, apologize. I guess I have to hit the button that says share my screen. So,
Yes.
let me go back just a slide. You know, thankfully, you guys didn't really miss anything as far as that money flow. We're paying our corporation, and based upon last time's example, we're at Lone Star Management, it's receiving a management fee of $3,000. So we have these main methods to remove the funds from the corporation: reimbursements, fringe benefits, salary, loans, and then dividends. So from a transactional standpoint, as far as documentation goes, in order for reimbursement, what we want to do is we want to submit a receipt or a statement that documents what the expense was and the purpose of the expense. And there's a couple of different ways that we can do this. We can have an itemized list that indicates what the charge was and what it was for, and we can just keep that itemized list and submit it over to our corporation. It could be something as simple as submitting a receipt as well. Now, I don't personally write a lot of checks. I do most of my transactions via credit card or debit card. And so the way that I'm submitting my reimbursement expenses is when I receive my statement, for example, on my personal credit card, if there's been any expenses on behalf of the business, what I do, because this is really nice because those expenses are already itemized in terms of who was paid, is I'll just highlight that expense. And for example, if it just says Best Buy on there, well, I'll make a little notation that I bought a printer toner on that statement. And then I'll give a copy over to my corporate treasurer for reimbursement of that expense. And what ends up happening at that point in time is if the corporation has the funds, then the treasurer, the president, or vice president will then cut a check back to me as a reimbursement, and that will then just get entered into the corporate expense ledger. Now, for a lot of us when we're starting out, because we have all of these expenses that we've incurred personally, now there's not a lot of money floating around within the corporation, or the expense is too large where we don't have that $10,000 right up front to turn around and cut us a check. That's okay. That is treated as an expensive debt for the business, and then that can be rolled forward to the subsequent year in order for us to be reimbursed. But the key is that we just want to make sure that we have that proper documentation, always itemizing out the expense and what it was for. There's a great program out there that I've played around with a bit. It's called Neat Receipts. Not that I'm giving them a plug, but it's great because you can put the receipts right into the scanner and it'll break them down after you've done the initial entry into what type of expense it was, and it keeps track of all of those receipts for you without having to hand your tax professional a shoebox full of receipts. They generally don't appreciate that all that much. So first and foremost, I've gone through and I want to get as much money back to me as I possibly can in regard to reimbursements. However, another benefit that I have in terms of being an officer and director of the corporation is that I can have fringe benefits. And the fringe benefits may or may not be deductible just depending upon the type of benefit it is. But for a lot of us, we're going to be incurring expenses on an individual level regardless of the level of activity that we have within our corporation. And the biggest item is in regards to medical. My son was just sick 2 days ago. We had to take him into the doctor, and I had to pay my $30 copay. I would have taken him to the doctor regardless of whether or not I had my corporation in existence. But since I have my corporation in existence and I have a resolution that allows reimbursement for medical expenses that I'm out of pocket on. Now, what I can do is I could submit to my business for reimbursement for that expense. It's just treated as an additional benefit to the employee of the corporation. So when we're directors and officers of the corporation, we're also classified as employees. A great example of what wouldn't be a deductible expense but can still be a fringe benefit would be in regard to a company car. If that company car is my primary driver and I'm using that company car for personal use, I'm going to have to recognize a portion of that lease or car payment potentially as income for my personal use within that business. So the key for that medical reimbursement is that you have to have that medical reimbursement resolution. And this will only apply to C corporations, not S corporations. And as far as the resolution goes, if it's a document that we've drafted, a corporation, this resolution's already taken care of for you. If you've set up your own corporation in the past, a C corporation, and you want to start benefiting in these types of tax-free fringe benefits, then you're going to want to pass your own medical reimbursement resolution. And that resolution is going to cover the employees and their dependents. So my children, they're too young to participate in the activity within the corporation. They're not old enough to be directors, and I'm certainly not going to name them as officers within the business. That's okay. I still get the benefit because they're treated as my dependents. So any expenses that I have for any medical care for my children and for my wife is going to be reimbursable to me from my corporation. The way that I go about doing that is I just pay for that expense personally and I submit for reimbursement. My corporation doesn't pay the doctor bill directly. I'm paying that and then I'm getting reimbursed. And the same thing would hold true if I was paying out of pocket for medical insurance. I would pay personally and then submit for reimbursement. If the corporation doesn't have the funds at this point in time to reimburse me, that's okay. That's just an expense that's locked in and we can roll that forward. Now, if in a given year we've maxed out our fringe benefits, we've maxed out our reimbursements, and we're just knocking it out of the park in regards to our business activity, and we still have money in that corporation, well, now becomes a time when we might want to start thinking about taking a salary out of the business. And again, as officers and directors, we are employees. So not only can we have tax-free compensation in regard to fringe benefits, but we also can have earned income. The key that I want you to understand when it comes to salary, when you're paying yourself earned income out of your business, it's well worth the expense to hire a payroll service that can calculate all of the federal withholding and the FICA and FUTA. They're worth their weight in gold, and that was just one less paperwork item that you have to get involved with, and it's really beneficial to have somebody else just take care of all of the withholding requirements and state unemployment withholding. It just makes it much cleaner for you. And along that line, one really important tool that I strongly suggest that you consider as far as running your business is having a really good bookkeeper. Just because we don't necessarily want to get bogged down in the minutia of having to enter in all the transactions and itemize each transaction or each trade, a bookkeeper is really important just to help keep everything nice and clean. And then when it does come for tax reporting time, everything's properly itemized and it makes the process extremely painless. Now, we have here, when we're looking at a dividend, and that dreaded double taxation that we hear about within C corporations. And for most of us, the reality is we're probably never going to pay ourselves a dividend out of our corporation. But C corporations do pay dividends. Generally, they're publicly traded corporations to entice investors to continue to hold the stock. But if you're ever at that point in time where you're electing to pay a dividend, well, we're going to have to do a little bit of paperwork when it comes to that. So when we're going to elect to pay a dividend, we're going to want to have a meeting for our board of directors. And we're going to pass a resolution to declare dividends. And really what a dividend is, it's a profit interest that's being paid out to the owners, the shareholders of the corporation. And when a dividend's declared, you're going to be paid from that business based upon a percentage of your ownership, your equity ownership within the corporation. The downside is that it's not a deductible expense to that corporation. So the corporation will still end up paying tax on those profits. And then you as the shareholder, when you receive the dividend, you're going to pay tax as well. And as Steve's going to talk about here in a few minutes, you're going to see that that dividend tax rate is dramatically changing as well. So if you're ever considering a dividend, I strongly encourage you to bounce that off of us beforehand. There are typically easier and more cost-effective ways for you to get your funds out of the corporation. One of those being is maybe we have these retained earnings within the corporation, and we need access to funds, but we don't want to necessarily pay ourselves a dividend, and maybe we don't want to take an additional salary out of the corporation. Well, our corporation always can loan us money, can loan monies to an employee. Now, should come as no surprise. We want to have proper documentation for that. And it's real straightforward. What we're going to do is we're going to have a meeting of the board of directors and draft up a resolution authorizing that loan to be made. Now, the key with these loans is that a loan has to be an arm's length transaction. So even though you own that corporation and you're an officer or director of that corporation, that loan needs to be commercially reasonable. So what we do is we want to make sure that we draft up a promissory note. That's an obligation for you to pay back that corporation, generally at a set schedule. It could be, I guess, a balloon payment at the end or an interest-only payment with the balloon principal at the end. Most of the time we're making equal payments, amortizing equal payments of principal and interest during the life of the loan. But that interest has to be reasonable. So right now, typically we're looking at 3.5%, 4% on the high end. You wouldn't want to go to either extreme. You wouldn't want to have the loan be 0.5% or have the loan be 20%. It has to be a commercially reasonable loan. And within that promissory note, we want to be able to dictate what the terms of the repayment happen to be. And so for me, those are pretty straightforward ways to get the money out of the corporation. We'll be having another webinar in the future dealing more with the bookkeeping component, types of records that you're going to want to keep. But I would like to hand the rest of the presentation over to Steve because there's a lot of information that he's going to cover in regards to what's going to be happening in the next 25, 26 days or so. And so, Steve, it's all yours.
Thank you very much, Greg. Well, now that the slides are working good, I'm glad we got that little bug worked out. And the one thing that I did want to mention as we get started here, you hear Obamacare called Obamacare, Healthcare for America. The official name of this act is the Patient Protection and Affordable Care Act. Now, this is something to identify with because basically it's three different sayings for the same area, for the same item. Now, on the next slide, we basically will mention that, and first of all, I don't know how Greg got a picture of myself on this, but anyhow, good job.
Your wife
with the
sent that to me. You bet.
Oh,
no problem.
Thank you, thank you. And with regard to the goal of Obamacare, because that's pretty much where we need to start with this. First of all, it is very complex, but it's understandable to find out where we are. One of the key components of the election 4 years ago was basically with regard to our healthcare crisis, so to speak. And it seemed like candidates on both sides of the aisle were basically stating how they could help with this crisis. And one thing that Obamacare is intended for is just to provide affordable health insurance for all U.S. citizens. Well, how it provides for affordable health insurance, unfortunately, is to create new revenue streams. And remember, a revenue stream for the government more than likely is going to be new taxes. But with Obamacare, it was basically set to reform and expand Medicaid so that it would help out an additional $17 million of our nation's poor. Now, it was under no circumstance was it ever, it was never intended to replace the private insurance, Medicare, Medicaid, or anything like that. But what it was doing was just to be a supplement for a way for the poor to actually gain access. And on the next slide, it basically states where's this funding coming from with regard to the new taxes and so forth. Well, I've updated this because when it initially came out, there were 22 additional new taxes that were going to be affected or to come into play in some form or another. Now, since then, it's now down to 18 new taxes. But keep in mind with regard to all the talk about the fiscal cliff and some of the badgering back and forth that we're hearing in Congress and between the president that we may end up back up there at the 21, 22. But for right now, it looks like 18 new total taxes. So enough to keep your head swimming, and mine too. Accountants call this job security, but the public basically just wants to know exactly where we stand, what taxes are going to be imposed, and how do I cope with these additional taxes. Well, one of the trade-offs that we came into was that the insurance rates were stated that they were going to be the same and that there would be no current rate insurance increases for 2013 or 2014. And everyone thought, well, okay, that will be great with that being federally mandated. But what about the later years? What happens then? And that's one of the criticisms with regard to this entire plan is that we are looking at significant increases coming back and actually hitting us in 2015, 2016 if there is an additional legislation that comes into play with this. On the next slide, when we're looking at the new taxes, one of the new taxes, and this is probably the most prevalent and is getting the majority of the highlights. So I wanted to list this first and make sure that we spend a little bit of time on this, is that currently with the new proposed legislation in place, the 3.8% is an additional tax on unearned income. Now, that's only if certain income levels are reached. Well, those certain income levels come into play at $200,000 of adjusted gross income for a single individual or $250,000 of adjusted gross income for a married filing joint return. Now, they say that the marriage penalty is dead. Well, I think here's another case where it's alive and thriving. One of the things that we look at is the items of unearned income that most of us are hit with. You have interest income, dividend income, capital gains, royalties, and also rental income. Now, if you remember a lot of talk, and this was, well, I want to say about June of 2011, there was a panel discussion that came out and said, what constitutes rental income as unearned revenue or unearned income? And basically the whole play was if you are classified to be a real estate professional, and remember, to be a real estate professional, we had to meet the guidelines. We had to have the so many hours of service that we had documented, the 750 hours plus per year, that more than 50% of our working time was devoted to the occupation of real estate, and also that we met the difference between the active and material participation, but with that we met that material participation. So all of a sudden, it's like, okay, I'm a real estate professional, so this doesn't count. Well, now recently in September, with some of the discussion that came through, there was actually a court case that was decided where the real estate professional designation passed on the IRS side of things for one of the audits that they had performed, but it was classified that this would actually be categorized as unearned income. And I think that's one of the scary parts that we're looking at, is that we don't have that clear guidance, to go ahead and say that this definitely will be left out of the mix. Because remember, if I hit that $250,000, there's a couple caps, and I won't get into all the differentiation here, but if I file a married filing joint return and I have, say, 260,000 of adjusted gross income, but I have 20,000 of these unearned income or unearned revenue streams, I'm not going to be taxed at the 3.8% on the 20,000, but only the 10,000, because that's what exceeds my adjusted gross income floor in this. So there are calculations that will come into play, but since this is the most widely scrutinized. Now, one other planning tip that I want to throw out there is, first of all, if you're looking at being in this type of situation or coming close to this, I highly recommend that you meet with your tax professional to do some year-end tax planning, because this is one of the first years in recent memory that I can think of that we are really trying to anticipate what the government is doing so far, and that we will even encourage people to let's look at our capital gains and actually put our capital gains in this year as opposed to next year. Many of you are familiar with the LV Sands. LV Sands actually declared a dividend, as did Walmart, a very significant dividend that was scheduled to be paid in January 2013, and they have actually moved that into 2012. Matter of fact, I heard some staggering amounts of the Walmart deal of how much that was expected to save their shareholders, that it was just mind-boggling. So that's something that we want to take a look at. Now, on the next screen, when we're looking at our new taxes, and
Steve,
this
can I
is
jump in just for one
sure.
second? I just based upon that point in regards to capital gains recognition, I was reading a great article this afternoon as far as George Lucas's sale to Disney. And George Lucas, through his entire career, has spent millions of dollars in regards to campaign contributions to the Democratic Party, and he recognized the sale of his enterprise to Disney this year for $4 billion, and by doing it the sale this year as opposed to waiting next year, he saved $176 million in capital gains tax. So yeah, we're in a very unique situation right now. Sorry for jumping in.
No, that's fine, Greg. And plus, you stole my thunder for line 19
Oh,
for our sorry thing there. But that's okay. I'll talk about the long-term capital gains in more detail there. So very good.
Okay.
Actually, this is what's great. Greg is phenomenal to add real life experiences to things, and some of the articles that we read just really come to the forefront about how some of these legislative moves are already impacting real life consequences of what has been sold, what we're looking at as far as dividends, capital gains, and how tax treatment is going to affect us. One of the next things, though, that we talk about is with regard to high income earners. There is actually now going to be an additional tax that's going to be recorded on box 6 of your W-2 starting in 2013. And that is basically for earners of income from W-2 sources now. If you've earned a W-2 with excess of $200,000, there will be an additional 0.9%, and it's a Medicare tax increase. Now, that's not so bad for a single person, but if I'm a married couple and say I earn $150,000 and my wife earns $150,000, we exceed that $250,000 level. Obviously, we'll have $300,000 of W-2 income. How does our employer know? Well, the problem with this is that they are not required to ask questions of other sources of income. Matter of fact, it may be against the law in some states to ask what your other outside interests are. But the thing to keep in mind is that you could experience a real shock, and I know 0.9% isn't much of additional tax that you'd have to pay, but you could be hit with an extra tax penalty if you exceed this as a couple or even as an individual and the company does not withhold that extra 0.9%. And yes, the bottom part there is going to be an additional line on the tax returns that will help you make sure that you do not miss this additional tax that is due to poor old Uncle Sam. With regard to the next screens, when we talk about penalties, now this is what I'm looking at here. This is how I feel when I'm looking at these penalties, because remember earlier the Supreme Court ruled, and if you don't remember the ruling, it was 5-4 that Obamacare, they're ruling on the constitutionality and also whether it was a tax or it was rightfully imposed. Basically, with the Supreme Court, they came back and said that, well, since this is classified as a tax, it is constitutional, and of course that's why we're stuck with living with this. But there are actually penalties that will be imposed on the individuals who do not carry health insurance. Now, the first year starts in 2014, and if you don't carry health insurance, it's $95 or 1% of your gross income, whichever is greater. So obviously, if I have a $30,000 of adjusted gross income, then I'm going to be paying, instead of $95, I'm going to be paying $300 in penalties if I do not have health insurance premiums. Now, or health insurance coverage. Now, you have to weigh out what the premiums are going to be versus what it's going to save you versus what your risk tolerance is. But these are things that will come into play. Now, in 2015, it goes up a little bit more, but in 2016, it starts to level off where the penalty will be $695 per individual or 2.5% of your adjusted gross income, whichever is greater. So obviously, there are penalties imposed here. Well, the other item that I look at is these are the penalties for insurance coverage for individuals. What about for the businesses? Well, as we go forward, the businesses actually, if a business does not carry insurance or doesn't provide insurance coverage, there will be a penalty imposed there as well. Now, this right here is a topic of great debate. And matter of fact, you may have heard about recent conversations with Papa John's was one, and there was just someone else today who announced, boy, it was I don't think it was Darden Foods, but anyway, it was a situation where companies with 50 employees must offer insurance. Now, when I first wrote this slide, I left off the full-time portion because when it first came out, there was a calculation in place to really determine what was full-time versus not. Well, now I have a little bit more guidance. It is 50 full-time employees. So if I go with 51 full-time employees, I am now required to offer health insurance. Now, with regard to my penalty, if I do not offer health insurance for my employees, I'm penalized as a business $2,000 per employee. So one of the things that we're kind of worried about is what happens if you currently sit and you have 51 full-time employees? What do you do? Well, the first thing that you look at is, can I reduce someone down to part-time status? Well, part-time status, if someone works 40 hours, all you have to do is reduce them 10 hours because by law of definition, I always thought it was 32 hours, but it's stated in the reports that 30 hours constitutes full-time employment. So if I have someone who only works 29 hours, then I'm not required to count them in my 50 full-time employee calculation. So this is one of those things that we have to watch out for. And the other thing that I'm kind of fearful of is if I sit at 51 employees full-time, what happens if I just eliminate 3 positions? And that's something that you have to be cognizant of. Now, even though this doesn't take place till 2014, the calculations start being in place as soon as January of 2013. So once again, if you're an employer, you have significant employees, that might be something that you definitely want to talk to us about or talk to your tax advisor about. Obviously, I want to provide as much guidance as possible. So if this doesn't apply to you, I'm going to keep moving on. But this is one of those things that I want to look at. The other thing is on that last slide there at the bottom is that if we have, say, 25 employees or less with average income of less than $50,000, you can actually get a tax credit for up to 30% of the premiums paid. Now, this is one of those tax planning ideas I also look at because most of the corporations may be owned by a husband and wife or a brother or sister. And this is something that you'd want to take advantage of, is that if you have even a medical reimbursement plan and you're paying your personal health insurance premiums through this, this would be something that I would obviously take a look at, with regard to making sure that, hey, if I'm entitled to a tax credit and I have taxable income, boy, this would be a great benefit to me. Okay. One of the things that I saw here float up, and I just want to digress a little bit, it says, one of the questions was saying, how do I know if I have insurance or not? Well, the one thing is that they're not going to know immediately. Now, after reporting comes into play in 2014, I honestly believe at that point that there will be registers that were going to be submitted from the insurance providers, and that there will be some cross-checking. Now, that's another scary area to get into, but I just wanted to point that out, that as of yet, that hasn't been fully determined. Okay. Now, this is one of the areas that has me kind of concerned, and it has to do with the expiration of the Bush tax cuts. Now, when I look at this, obviously, I have some critical areas. I mean, these are massive changes that are coming through. And the first one is my income tax rate is going to go up, because right now my income tax rate could range anywhere from 10% if I have taxable income up to 35%. Well, in 2013, that automatically jumps up to 15% to 39.6%. Well, that 39.6% may not even be a true number, because can it technically then go up to 43.4%? Because if I have that 3.8% tax on top of it, well, now I could be looking at 43%. You jump into a state tax issue, and I could easily hit 50% of taxation. The next one is another one that has me concerned, but also provides for some good tax planning, because when I look at my long-term capital gains, 2012, it could range between 0 and 15%. More than likely, if you had any adjusted gross income at all, it's going to be 15%. Well, next year, it's going to be 20%. And then if your adjusted gross income meets those limitations of $200,000 for a single return, or $250,000 for a married filing joint return, now all of a sudden I could be looking at 23.8%. Well, if I do the math on that, that's over a 50% increase in tax. And this goes back to where Mr. Booth, Greg just kind of jumped in there with his George Lucas criteria, and that was really a very interesting article. One of his main concerns, and I thought this was very interesting, that he didn't sugarcoat it in any way, is basically he's saying, hey, with these long-term capital gain treatments, I can save 50% off my tax bill if I go ahead and consummate the deal with Disney this year, as opposed to waiting next year. And that's one of those things that kind of spurred on this movement to go ahead and make sure that he got the deal done this year. Does that sound about right, Greg?
You got it right, Steve. Sorry about that. Didn't mean to steal your thunder.
You know what? That's the thing is, with this, there's so much thunder in this and these proposals, and there are so many tax planning ideas, and there are so many ways that we can try to save money, that really all of these are just endless. And I just saw a question that just popped up here. It said, do I just contact our tax preparer or do I need to ask to talk to one of the CPAs? Basically, with regard to one of your tax professionals here, we are all up to speed on this and we can answer your questions. If you have some in-depth tax planning, I would recommend that you contact us sooner than later. We are really finding a lot of people are moving forward with trying to position themselves into the best light possible. Okay. Um, the other thing that's very critical here, and this is one of the things that I call once, the dividends. The dividends now, if they were qualified dividends, they would be taxed at your capital gain rates. Well, now it's a situation where the dividends are going to be taxed as ordinary income. Oh my, once again, here we are with dividends. Remember also that they were on that unearned income slide. So once again, if you have any state income tax at all, or even in California, you're going to be over 50% of taxes paid on dividends if your just gross income exceeds those income limitations. So once again, very scary things to look at. You need to make sure that you're planning for these things as well. Okay, with regard to some of the individual changes, things that we're looking at there is this, remember the right to work credit? You had it a couple years ago for 2 years. It would pay you either $400 or $800 depending on whether you did a single or married filing joint return. Well, that was great because that wasn't money taken out of your paycheck, but that was just given to you as a tax credit. And what that helped to do is try to ensure that, hey, instead of having a payment that was due to Uncle Sam when I filed my tax return, now all of a sudden I was getting that money back. Well, the problem is that Congress seemed to think that, well, we weren't utilizing those funds the way they intended. And so what they did is they gave us this payroll holiday. Well, the payroll holiday was just a cute way of saying we're going to give you a little bit more back in your paycheck each pay period. So that basically what would happen is that I basically get a situation where my extra 2 percentage points of my gross wages for my Social Security portion, which goes up to $110,100, basically is a situation where I'm going to be able to spend that money as it comes in. Well, last year they had the big filibuster and they didn't know if they were going to extend it. Well, come along and through January, after they get off their vacation, which I also thought was very interesting, Congress went ahead and passed it. Well, keep in mind, this is another area where it doesn't seem like a lot, but that 2% amounts to about $2,000 in your pocket if you max out for Social Security purposes. So keep that in mind when you're thinking that maybe this isn't a big deal, but it's like if I were to go ahead and put, $2,100 bills in front of you, would you stop to pick it up? Well, I know I would. So, but this is what this amounts to. This is the type of break that is meant to kind of spur the economy a little bit so that you're out spending that money and not just putting it into a savings account. Okay. Now, keep in mind Social Security rates increase for 2013. So that type of benefit would actually be just a hair over $2,000 in savings. Okay. The other individual changes as they're continued. This is something I really want to caution against. If you've attended any of the Boss Inc. this is something that I like to talk about a little bit because I thought, what a wonderful master plan to try to increase revenue, because this is what this was. In 2010, there was a conversion that was eligible that you could transfer your monies from a traditional IRA to a Roth IRA. And Congress was so nice about this. They said, you know what? You don't even have to pay this tax amount in 2010, we'll let you have that election to spread it so that it's half payable in 2011, half in 2012. Well, as many people found out in 2012 when they claimed this other half of their Roth conversion, boy, it sure did put them into a higher tax bracket. Especially if you had, say, $150,000, $200,000 now in a traditional IRA and you're transferring that to a Roth IRA. I'm picking up 100,000 in 2011, 100,000 in 2012. That kills my adjusted gross income, puts me into a higher tax bracket, and may have even cost me more money than I originally planned for. Okay? Now, with regard, I just got a thing about losing volume, so hopefully everyone can hear me okay. With regard to this Roth conversion in 2012, people are still coming up to me and saying, Steve, is this a good thing for me to do? Well, if I look at it in 2012, you can make the argument to me for that. 2013, I don't think there's any way you're going to be able to convince me that it's worth to do the conversion, plus with it kicking me into a higher adjusted gross income so that I exceed some of those levels. Now all of a sudden I've got a situation where I'm paying a 3.8% Medicare tax just because I took advantage of that Roth conversion. Plus, I always remember back to Social Security. Now, obviously, I'm not old enough to remember this firsthand. Greg is, but I'm not. With regard to what President Roosevelt said about Social Security. President Roosevelt made the famous speech that Social Security benefits will never be taxable. Never. Well, they're saying the same thing about Roth IRAs. As we know, Social Security benefits can be 50% taxable up to 85% taxable. But the Roth conversion? What do you guys think? Interesting anyway. Well, moving on with the final of the individual changes. Did want to point out that there are some HSA restrictions for 2012, and this carries forward to 2013. Basically, over-the-counter medications are no longer eligible for the HSA benefits. Now, keep in mind that with regard to medical reimbursement plans, that's something that you want to make sure that you've talked with Greg about. Make sure your resolutions have everything covered for you. Make sure that you have that resolution in place. All right. I think the bigger kicker here that I wanted to mention is that for those of you who are running your medical expenses through the Schedule A of your 1040 instead of through your medical reimbursement plan of your C corporation, think you're missing the boat. And here's why, is basically you receive what's called a haircut, meaning that with regard to the amount that you spend on your medical benefits, on your medical plan, on your hospital visits, your doctor bills, your dentist, your vision care, all of those things basically have a 7.5% limitation that has to be exceeded before you get $1 of those deductions. Now for 2013, next year, that goes up to 10%. So let's take the example of a family who has $200,000 of adjusted gross income. I'm going to have medical expenses that exceed $20,000 before I get $1 of benefit. Once again, $20,000. That's significant. So to me, if you have not made that your plan of action, I just can't express this enough. You have a significant challenge ahead of you, but I think that you have to contact Greg, talk to Bob, get your medical, get everything documented within your C corporation for your medical resolution so that you can go ahead and take that deduction. Okay? Now, as we turn over, there's one other area that I want to concentrate on here just a little bit because I really think that this could change. This is something that I really want to take a look at. And before we get started, I did notice that there's a bullet point of a penalty increase. You can just ignore that. That's a carryover from one of the prior slides. When I was looking at this, the cancellation debt on a qualified personal residence, remember, if you had a personal residence and you were foreclosed on, what happens is whether you get a 1099-A, which is for the abandonment of the property, and or a 1099-C, which is for the cancellation of debt, it's a situation where you will have what's known as a 1099-C for the cancellation of debt being given to you at the end of the year. Well, the problem with that is usually reportable income to you, which means that even though you lost a home, you lost the value, you lost your nest egg that you were trying to build, the IRS now says, hey, the bank issued a 1099-C, where is it on your tax return? Why isn't it on line 21 of other income of your tax return? Well, the thing is, if it was your principal personal residence, you didn't have to worry about that. You said, hey, here it is on my 982 form. That's showing that this was actually realized, and hey, I qualify because it's my principal residence. That expires December 31, 2012. So if you haven't already gone through the situation, you didn't know if you were going to short sell your residence, which is another way that you could actually receive a 1099-C from the bank or lending institution, these are some things that come into play, and you're losing that. Now, granted, this may be extended, and there's some talk that this will be extended for one more year. However, make sure that you talk to your lending institution if you're going through this to make sure that it didn't get postponed into 2013, especially if this is your principal residence. And then, of course, the other way to knock out this debt cancellation income is if you are in Title 11 bankruptcy or if you qualify for insolvency. And keep in mind, you just can't say that you're insolvent. The IRS has a 3-page summary worksheets for insolvency that you're required to fill out as well. Okay. With regard to estates and trusts, this is one of those things that, boy, if I have an estate and I have someone who may not make it, no, I won't even joke about that. Keep in mind that your tax exemption for your estate will drop from $5.12 million, that's over $5 million, and it will drop down to $1 million next year. Also, the top marginal rate goes from 35% to 55%. Now, the reason that I mention this as well is because there is a portability election. And that portability election is something that would need to be made. You may think, oh, I don't need to file a 706 tax return because I have a situation that, you know, I'm well under the estate limitation, so forth. So when a husband, wife, or a spouse of one or the other passes away, you really need to look at making this election so that the other surviving spouse will be able to reap some of that exemption limitation. And that's something else that I would honestly talk to Greg about. If you've had a death in the family, I would definitely talk with him before this year has expired. That way you know some of the planning tools that you would have. It's one thing to grieve, and obviously that comes into play, but it's nice to be smart about your tax situation as well. And then leads me to the last, which is the business update. Keep in mind that the 1099s and the 1099K and all of these provisions that we thought we were going to issue 1099s every time we went and shopped at Home Depot or Lowe's. Well, that actually has come to where Congress has said, you know what, this may be overkill. So we're not going to worry about the 1099s that are issued. And also one other case that I had pointed out is there was a Campbell case. And Campbell operated a business that he thought was basically for profit and thought he had the proper profit motive. One thing I want to point out here is the IRS has increased their audit of these small businesses. Matter of fact, one thing I was going to shoot to Greg is the number of businesses that are actually audited as a sole proprietor as opposed to a C or an S corporation are staggering. So that's something that we definitely want to take a look at is please do not utilize a Schedule C if at all possible. If you do have a business that has a Schedule C, we need to find a way so that we can actually categorize that differently. S corps and partnerships each have a taxability of less than 0.5%. Now that's not 1.5%. That is less than 0.5%, and that's staggering. So with regard to that, that's one of those things that we definitely want to make sure that we mention here, because the IRS for 2013, they're going to really be hot on these small Schedule Cs. Okay. Well, that brings me to the end of my portion as well. Um, Greg, I see that we have some questions here. Do you want to go down through the questions, or?
Yeah, I'm going to actually let you field this one. It's the last question that we have, and the question is that in the first year of the business being formed, it generated revenue other than just from the trading activity. He hasn't received any 1099s for his corporation. How does he account for that?
Okay. With regard to the trading activity, I assume it was through a brokerage firm, or?
That's correct. But the income that he's received from the corporation is income independent of the trading. So he's conducting other business than just managing the portfolio.
Oh, okay. Well, basically, the thing that I look at is we have tax organizers. And with regard to the corporation and how you document those and how you account for those, even though you don't get 1099s, you're still required to report that income. So what I look at is keeping track of those revenues, whether you use QuickBooks or Peachtree. And then at a minimum, we have what we call our tax trackers. And if you go to our website, www.boss.com or bossoffice.com, or even go to the Anderson website, which probably be better right now, then we can go ahead and look at those tax trackers so that you can actually keep documentation of those on a monthly basis as well.
Yeah, that's a great point, because again, it always comes down to the documentation. So if you're looking for a good source to be able to categorize those expenses, definitely go to the website. And I know that Bob, he has a great source of just being able to account for individual transactions. So if you're looking for some type of receipt or documentation to capture those expenses, please contact Bob Wilkinson. And let me just go over to the next page here. Bob's phone number is 800-706-4741, and you can also email him directly, and Bob can certainly provide you some additional documentation. But go to our website for the tax tracker information. And if you're interested, and I know a lot of you are already existing not only Anderson clients, but also Anderson tax clients, the service that Steve and his staff provides is just exceptional in regards to being able to capture and categorize those expenses. And the way that we're looking at it from a rate standpoint, just like with the other services that we do, where you know what it is that you're getting into as opposed to going on this hourly type treadmill, we can prepare your federal 1120, that's your corporate return. It's $500 for the return. If we're doing a return for your partnership or LLC taxes, a partnership with your trading activity, it's also $500. And I'll going along those same lines for your personal 1040. As long as you're not a Schedule C filer, you're not a sole proprietor, that would also be $500 as well. And what we pride ourselves on, not only on the legal side, but also on the tax side, is being proactive and use this as a resource. And that's why I can't stress enough, that's what you hired us for. So when you have questions, whether it be legal on the tax side, don't hesitate to contact us. That's why I'm here, that's why Steve's here, and then that's why we have the staffing that we do, to make sure that you're never wandering around in the dark, especially in these turbulent tax times that we have. So I definitely recommend that you guys all take advantage of the services that we provide. Contact myself or Steve or Bob directly. Bob will be a good resource for you. And I'd like to thank you, Steve, for taking time out of your busy schedule to join us this evening.
Well, thank you very much, Greg. I appreciate it.
You bet.
Uh,
And
I,
oh,
I,
I'm sorry,
I
go
was
ahead.
just going to say, not to interrupt you, I did notice that there was one other question or a couple questions to address, but I've made some notes. Some people had asked some questions that we didn't get quite to, and I know I ran over a little bit, but I just wanted to make those individuals known that I go ahead and shoot an email, but also, like Greg had mentioned, with regard to letting us know questions and so forth, contact, with Bob's email address right there. That's wonderful. Um, don't hesitate to ask us, whether it be on your entities, on tax, bookkeeping, whatever, because there are some other good inquiries as far as with year-end tax planning that we should address as well. So, but
Absolutely.
thank you very much, Greg. I appreciate it.
You bet, and thank you guys for taking out the time with us this evening. Those of us here in Washington and also in Las Vegas, we wish you all a happy holiday season. And this presentation will be back up on our Platinum member site either tomorrow or Monday at the latest. If you weren't available for last month, or if you want a refresher, it's on there as well. You just want to go to page 10 of the videos and you can view it. Thank you. Have a great evening, and we'll be talking soon.
For your